Hi, and welcome to Macro Wednesday, where we talk macro and try to make sense of markets that really don't make any sense. And how can they make any sense when people are just dogpiling into tech stocks in the middle of a pandemic as if like something they're going to miss out on it? Meanwhile, and I just saw this on Twitter from Northman Trader. He posted that short interest. So what is short interest? Short interest is the people who are either betting on the market going down, so betting on stocks going lower, or are hedging their long stock positions, by adding some, downside protection. Lowest level in 15 years. How does that make any sense? I'm Steve Van Metre. Thanks for joining me today. And how can you not laugh when you have the most awesome royal watermark that you don't know how to point to sitting there in the corner? Today's episode is about the Powell Pre-Presser. I've had several people reach out to me in all different forums asking, hey, would you delay the Wednesday video, so you can talk about what's going to happen on Thursday? And the answer is no, because we're going to talk about what's going to happen tomorrow, today. And you're going to be amazed at how close of a prediction I can get to this thing. At least I'm feeling pretty confident about it. Maybe I'm completely wrong. But I think if you look through the markets, and that's kind of what we learn on the show, is how to look at the big picture and try to anticipate what's going to happen. I think you'll see that tomorrow's press conference, even though I will be watching it, it's probably not that big of a deal. So I want to start out by talking about the M2, the money supply, because everybody looks at it and thinks it's inflationary. And we've talked about this a number of times, but I want to give you a whole different view of what it takes for the M2 to be inflationary. So here we have the M2 skyrocketing higher. Of course, I can't find it on my screen. There it is. And it kind of looks like, an equity topping pattern, but for the moment, it's fairly high and rising. And, the notion is, this is going to be really inflationary. And I've been saying it's not, and it's not going to be. So I want to ask you, what is it that you need with the M2? Now, when you get the M2 rising and this, then it's inflationary. You take a guess. If you need to pause the video for a moment, pause it, think about what do you need with the M2. Now, I have a hunch that some of you are thinking that it's probably something to do with Treasury yields because all you talk about is bonds. And the answer is no. I know, you didn't see that coming, right? No, interest rates will go up after the fact because of this. In order for the M2 to be inflationary, you need to see lending growth, right? Because what is the M2? Well, if we go and look kind of underneath, it's mostly checking and savings accounts. Yes, there's some institutional money funds that comes out of your brokerage accounts and IRA accounts and 401k type accounts. That's the money market or cash position. But a lot of this demand deposits, that's checking accounts, and up here you can see savings deposits. Huge, the largest component of it is savings deposits. So why does lending growth matter in this situation? Well, think about this. How is money created? Well, when people borrow. So let's say there's a burst of lending, right? And people are spending it. Some people are, saving it. Not that they're borrowing to save it, but you get paid for a service and your business is going well, so it starts building up in your savings account. That becomes inflationary because when that new money gets flushed out of the M2 and gets into the real economy, boom, you get a big burst of inflation. And yet everyone looks at this M2 and like, oh man, it's going to be so inflationary. CPI is going to go through the roof. And I forgot to pull up that chart that I've got. I think I have one of the M2 versus the CPI. You know what? Let's just go back here and we'll do it together. So that some of you I know are trying to learn how to use Fred, and I am not the best at it, but maybe seeing me do it will help. So we'll put the consumer price index here, and I want to move it over to the right. And you can see pretty easily that just because the M2 is rising does not mean inflation is going to rise on a year-over-year basis. It does not mean that at all. It does mean when there's lending growth. And here's a point where you see the M2 rising, and this is a period of lending growth. And we had, the CPI running over 2 and pretty solidly just around that 2% level. So you have to see a rising M2, and lending growth. Now, if you listen or watch the Friday video, you already know there's no lending growth. Not going to happen because there isn't enough demand. And so when I look at the data, right, when I look at the weekly data, now this is not the best thing to look at. I do enjoy looking at it every week, and it is the MBA mortgage applications. Now it's down 6.5% this week after falling 3.3%. And that doesn't mean much yet because this index is really volatile. In fact, you can see here when I pull it up that it's really noisy. But going back to where it starts here back in 2009, and you can see there's a period where even though it's bouncing, the trend was falling lower. And that's really what I'm interested in finding out is at what point does this trend go lower? The other challenge here is there's not enough lending growth as it is to keep the machine running. I mean, remember we look at on Friday, the rolling 90-day commercial real estate lending growth is like 0.5%. I mean, it's weak. It needs to be triple that or more. It really needs, we should be seeing the year-over-year rate of change in commercial or residential real estate. It needs to be at near 8% growth, and it's not happening. So when you look at that M2 chart, and let's go back to that so you can have a look again, and you see this up here, how do you know there's going to be inflation? If there's a lot of lending demand, because everyone's saying, well, but all this fiscal transfer. Okay, so what about the fiscal transfer? When the government borrows money, I want you to think about this. When the government borrows money, do they create money? No. The government does not borrow from the bank. It borrows from the people who already have dollars. So, if you and I are standing in line to get ice cream and I say, hey, can I borrow $1 because I left my wallet at home? Look, money is not created when you loan it to me. It does not, it's not like, oh, hey, you open your wallet, oh, there's an extra $1 here because I'm a bank. No, it doesn't work that way. Think of the federal government as a dollar redistribution machine. What? Yeah, think of it as a dollar redistribution machine. Well, what does your heart do? It circulates blood, right? It moves it around. It doesn't create blood. It circulates it. And that's what the federal government does. It takes dollars from people who have it and gives it to people who don't. I mean, it's a dollar recirculating machine. It plays a very important role here. The key is they don't create money. Now, in order for the M2 to be inflationary, you would have to see that people are going out and borrowing money and spending it. Now, we're not seeing them borrowing it, but even if they did, any inflation would be very transitory because this buildup in the M2 is not due to new dollars. It's due to existing dollars, and that's very, very important. All right, so let's talk about what's coming tomorrow. And there's rumors abound about inflation targeting and all kinds of garbage from the Fed, and that reminds me I forgot to have something ready for you to look at. And so here's the deal. 2%, this 2% inflation target is probably out. Big deal. It's not like the Fed could hit it consistently anyways. And this is an issue that people that are new to macro and new to investing and even people that have been around a while that look at the Fed, I tell you what, do not believe anything they say. It's important that when they actually say, we're going to do this, and then you go and look at the minutes or you look at the implementation notes and say, hey, they're actually doing it. Then it's legit. If they say, look, we're giving you forward guidance, whatever it is they're forward guiding, they're just jawboning. I think I posted on Twitter the other day that the Fed preys upon the ignorance of consumers and investors because they believe what the Fed says. So what the Fed's probably going to come out tomorrow, and don't worry, even though I'm going to predict mostly what's going to happen, I will still watch it just so I can be surprised if I'm wrong, is that Powell's going to come out and say something about new inflation targeting or whatever that's going to involve letting inflation run over 2%. And everyone's going to go, oh my gosh, if inflation could run over 2%, Powell must be thinking that it's going to get hot. It's going to get to 2.5 or it's going to get to 3. I better cram into tech stocks. I better sell my bonds. Yeah, you get right on that, okay? Because all he's going to say is, rather than start tapering at 2, like we've done in the past that didn't work, that if by some miracle, if luck has it, and the inflation genie finally shows up after 40 years of absence, because it has, we've seen declining consumer prices on a year-over-year rate change, 40 years, If by some stroke of luck it gets to 2%, we're gonna let it go. We're not gonna taper until it gets some higher level. And investors interpret this to be like, oh, the Fed's got a new tool. Like Powell's going to roll out, the money printer 5,000 and say, look, everybody, we've got the solution that we've been looking for 40 years. It's right here. And the answer is no. See, everyone thinks that, oh, the Fed's got a new tool. Look, if you want to know if the Fed has a new tool, go read the Federal Reserve Act. It's very clear that the Fed can't print money. I don't care what anybody says. It's very clear about that. And the only way the Fed could get a new tool is if the Federal Reserve Act gets modified to do it. And guess what? It hasn't. So we know the Fed's got nothing new, which means the Fed still doesn't have the tools to create inflation. I mean, you got to think back when the Fed was born, when they were created, what was the problem in the monetary system? What was one of the biggest ones? Wasn't the only one, but one of the biggest ones. Inflation. There was never a point at the creation of central banking where like, hey, we're going to have this big deflationary problem down the road and we better create an entity that can print money. No, the problem was, man, we can't control inflation. So they built the Fed with some of the most, if not the most restrictive rules of any central bank. And the Fed has two tools. Federal funds rate, which is zero, so that's not going to change. Big prediction, federal funds rate not changing tomorrow. And they have quantitative easing, which changes the monetary base. See, if the Fed could affect the M2, which so many people think, oh, the Fed drives the M2 up. Have you ever received money from the Fed? Because I haven't, and I don't know anyone that has. So there you go. They do not have access to the M2. If they did, we would have inflation because they would just send people money. Very simple. So we know the Fed's going to continue doing $120 billion per month of QE. The Powell made that very clear at the last meeting. That is a minimum. So guess what's not going to change? QE. In fact, I will predict that he'll say that is the minimum and that we may need to do more. And if we need to do more, we'll do more when conditions warrant, which he'll be vague about because he doesn't know when or why. He just might do it. The federal funds rate, as I said, will not change. So here's the deal. Nothing's going to actually change. And you're like, wow, how can you believe that? Well, the answer is the smart money tells you that. And let's go look at the auction data. Now, you're going to see my open broadcaster screen for a moment as we flip over. Rather than take you to the Treasury side, I've kind of netted the numbers out so you can see the percentages. And I want you to see what's going on with the smart money because the smart money already knows what he's going to say. They already know. Now, they may not know word for word, and they may not have a copy of speech, but I guarantee you, they know how this is going to go, and the auctions prove it. So let's take a look at what's going on there. So this is back at the beginning of the month. I just started doing this last month, and I thought it's pretty interesting. So a 3-year note auction was $48 billion, and this got billed as a crummy auction because the foreign investors, which are indirect, direct is U.S. investors, and primary dealers are securities dealers. So securities dealers do bid on it, but they effectively exist to mop up any extra demand if there is extra demand. But don't worry, they do bid on these. So everyone cares about what foreign investors are doing. So, they took 57%. It was down a bit. It was billed as a terrible auction, but it really wasn't. Then the 10-year note, this massive 10-year, $38 billion auction. Remember, we talked about this. Boom, huge demand is 65% from foreign. And foreign bidders are by and large foreign central banks. Not entirely, but by and large. And everyone was shocked by that. And then the 30-year, and everyone's like, all right, for sure, this is a dud. And at $26 billion, it was actually pretty good because it's massively oversized. This 10-year and this 30-year were very large compared to their normal. It still saw decent demand in the market. That was terrible. It wasn't at all. And then the 20-year bond came out. We looked at it at $25 billion. It saw very good in foreign bidding, even though this was oversized. And then yesterday, we get a $50 billion 2-year note, and this is very strong foreign demand. Now you say, well, it's not over 60. It doesn't. Just relative to some of the prior auctions, this is good demand. And then today, the bond market was like not the bond market, the equity people are like, all right, today for sure, no one's going to buy 5-year notes. Super strong foreign demand at 66%. It's huge. Look at relative, $28 billion in 2-year, $33 billion there. Now, what does that tell you? If Powell had, the inflation money printer 5,000 he was going to roll out, do you think these foreign investors would be gobbling up these 2-year, 5-year, 20-year? Do you think they'd be doing that? No. They already know that Powell's effectively going to say that rates are going to stay low forever. I mean, he's going to act like at some point they're going to rise, but let's be serious. That's not going to happen. So we know that from how the smart money is behaving. Now, why do foreign central banks buy bonds? There are two cases. The primary case is because they're mopping up all these dollars that are circulating around the global economy. Now, we know that's not really true because the global economy is really in bad shape from the pandemic and continues to be. So why would foreign central banks be committing their precious dollars that they need into auctions right now? Well, it's simple. The Fed is buying $80 billion of these things a month, $40 billion of mortgage backs, so a total of $120. And if you own bonds, because you are the bond king, and why not, right? We got to have the crown on when we talk about buying bonds or owning bonds. When you own bonds, whether you're a U.S. investor, foreign investor, doesn't matter, and you know that quantitative easing does what for interest rates? Makes them go down. And what does falling interest rates do for bond prices? It makes them go up. Well, guess what? You can go buy these things and sell them back into the market, which will float into eventually the Federal Reserve at a profit. So what's interesting is you see that at some point, foreign central banks, they'll when they need dollars, they'll sell them. But when they know the Fed is not far off from doing a massive amount of QE again, they'll start building them back up because they're going to sell them at a gain. They're going to take whatever dollars they have to commit to these and get more dollars in the future. Isn't that cool? That's what the smart money knows. That's how they play this game. The smart money's been mocked for years. Since 2016, they've been buying and sitting on bonds, and everyone's calling them idiots. And in the end, they're going to end the game with more money and equity prices at a lower level, because we've talked about that relationship between stock prices and treasury yields. And at some point when treasury yields go down further, stock prices will follow. And that's where the smart money shows up and buys them. Now, let me show you in this spreadsheet. I've been tracking something else, and I mentioned this, but it's worth looking at. And I know you can't see that. So, whoa. What I've been doing is I've been tracking what's going to the primary dealer. So over here, I've taken the primary dealer take in July, and I added it all up, and it came to $71.7 billion, and the Fed is buying 80, meaning the primary dealers are short $8.2 billion of treasuries. Again, that everyone thinks that nobody wants, that they have to go out into the market and source to flip to the large commercial banks to then in turn sell to the Fed. Now, I've been tracking the August data, and let's see where it comes out. Let's do 2. And here we are so far. There's one auction missing right now. That's the 7-year. That is tomorrow. All the other auctions for the month are done. And right now, the tally is $61 billion, meaning there's $19 billion short. Well, last month, the dealers got a little over 8. So you can predict now that the primary dealers are going to had to go out or are going out to pick up a $10 billion shortfall. Now you're asking maybe what this column is over here. I tabulated what the Fed is approximately buying based on their quantitative easing purchase. So in the range of 2 years, they're buying $25 billion, and 3 years they're buying 17. And this 5 to 7, it seems like there's a gap, but some of the 17 floats into here. It just depends on where the maturity of these bonds. I didn't get that granular. I just looked at the broad range of where they're buying. 10 to 20 year, they're buying around 7.2. 30 year, they're buying 10.5, and they only needed 7. People say the interest rates on the long bond are going up. Really? The Fed is buying more than new supply. And then TIPS, which is not much in demand for, there usually is only about one auction a month for these three, and you can see that they're buying over $7 billion, and the new supply was 1.5. So there you go. There's your case for why interest rates are headed down due to the Fed. It's pretty neat to see that breakdown, and I'll keep track of that as we go forward and share that with you. Now let's go take a look at the charts real quick, and what what's wrong? Oh, I was like, wait a minute, something is wrong. There we go. Let's go over to the charts and let's look at Treasury yields, and then we'll look at bond prices. Because remember, we don't need to look at stock prices. Everyone's cramming into them. I mean, why on earth was Netflix decided it needed to be up 11%? Because people have FOMO. They're cramming into these tech stocks. Look at Facebook, up 8%. I mean, it's like, did you just hear about Facebook today and decide to invest? I mean, it's crazy how people are jamming ahead of this Fed meeting. Now, why would they do it? Because again, they're bought into this whole inflation thing. The Fed can create inflation. And what do we already know? It's not going to happen. Not only is it not going to happen, but the bond auctions are telling us the Fed's not raising rates. They're creating a safe zone for all these people sitting on bonds. It's pretty cool. Let's look at the 30-year. So again, market's backing it up right into this overhead resistance level where it keeps getting rejected. Again, break 1.2%. That's the magic level. But it's still not going up. Everyone's like, oh, look, yields are spiking. Yeah, okay, sure. If that's what you call a yield spike. Let's look at this. Remember, now let's go back to our football analogy. I know some of you really enjoy that. So remember, up in this top part here, this is where the Treasury bears that want to see prices go down. Down here is bulls. And if you're a fan of the NFL, whenever the bears are on offense, you know something is not going to go right. You know it. So what happened here is the Treasury bulls held at the 35-yard line, pushed. Defense pushed the offense back, pushed them back. The offense, because they seem to have trouble playing during the day, overnight, big play down almost near the 35-yard line. The defense holds. And then they come out swinging this morning, running play, right up to the 35-yard line again. Defense holds. Now, what we know about the Bears offense is at some point there's going to be a turnover because, well, it is the Bears offense after all. But this point here, you can see, as I kind of predicted, because the Fed is gobbling up more than the new supply and the primary dealers need some inventory, they're pulling prices down to yank out all the last bit of sellers they can get. And this is coming ahead of tomorrow's announcement, which everyone's going to be, the equity bulls are going to be massively disappointed. And they're going to find out why people have come in here and why these foreign central banks are buying all these bonds and why defense is holding here. Because once this holds, the last breakout point is right up in here, which matches about 1.2% on the 30-year, the mirror. So once this gets over here and breaks, and right now you can see the defense is holding. The only question is, when are we going to get that turnover? And probably not that far off in the future because the game is set, right? We know next month that there is going to be a shortfall. The Fed is buying up more than the new issuance of these notes, bills, and bonds, or not bills, notes, bonds, and tips. The Fed is really not buying bills. We looked at the H.4, and we already know that. So good time to be bullish on bonds, because we're the bond king. And what happens to those equity people that find out they're crammed into market cap weighted indices with the short interest at the 15-year low, which means in the past 15 years, you haven't seen a market with more people crammed into the same 5 stocks. Well, if you don't know how that story ends, be sure to then like and subscribe, because I keep forgetting to do this. I know you will anyways, but like, subscribe, and we'll be back. Oh, the Real Vision interview got postponed until Friday, which they wanted some charts, so I sent them some charts. But as Brent and I conferred, Friday's clearly a better day. So I'll see you Friday, and look for that interview to release at 9 p.m. Pacific, noon Eastern time. I'll see you then. The content of this video provides educational information only. It's not intended to provide investment or other advice. This material is not to be construed as a recommendation or solicitation by or selling security, financial product, instrument, or participate in any particular trading strategy. This video was prepared by Steven Van Metre. Personal capacity opinions expressed in the video that I do not reflect the view of Atlas Financial Advising or Steven Van Metre Financial.